So, hello everyone, thanks for joining. First of all, let me introduce you to what myinvestbuddy.com is. We are three grads who observe that a lot of people struggle while doing their financial planning and investments. So we came up with an initiative to help people take prudent financial decisions. So My Invest Buddy is our blog by which we facilitate this process. If I show you. Mutual fund series is our one such initiative, and then tax saving is our one such initiative. So in today's session, we will focus on one thing like how to analyze a stock mutual fund. So having talked with our friends and family members, we observed that lot of people while investing in mutual fund, they make some mistakes. For example, they focus too much on past returns and they do not look at the things that should be looked. So we thought we'll create some framework. So next time, if you plan to invest in something, you can analyze it with the lens of this framework, so that uh, you are clear on like whether this is a sensible investment or a sensible approach or not. What you'll be able to get from this session is the very first objective is we'll try to give you the process of selecting the right mutual fund. So what are the things that you should make? Second thing that we'll cover here is the most common mistake that people make, the general observation is people give too much importance to performance. Past performance is necessary, but then the right principles and right approach is more important than the past performance. So, like past performance may not be sustained in the future. So, we'll see what are the other things that should be taken into consideration. First thing first is asset allocation. So every time you make a plan for yourself, the very first decision a investor has to make is the asset allocation. So asset allocation stands for how much of your investment should be in stocks and how much should be in bonds. So this is the very first decision and very important decision that because this very person to person. So this has to be very personalized, and then this is the very first important decisions. And then we may will cover whether investing through mutual fund is the right approach for you. It might not be right approach for you. So we'll see like what are the benefits offered by a mutual fund investment. So there are certain people who can take bets on individual stocks and but not. There are a lot of opportunities in the market. The very first thing you should be convinced that this is a right investment, like right option for you. And then we'll discuss the most important part, what is the framework of analyzing this stock mutual fund. So mutual funds come in like there are a lot of mutual funds like stock funds, bond funds. Broadly, we can divide it into stock and bonds. And then this like based on your background, and then based on the time you have put into this, you might feel like this is too much of a work. Is there an easy way? And then yeah, like luckily there's an easy way. So then we'll discuss that, and then we'll summarize a few takeaways from the session. So during the session, anytime like you feel there's something that you have some question, like feel free to unmute yourself, and then let's make this session an interactive one. The very first thing is this I discussed earlier as well. This is the common mistake that people take, is like giving too much importance on past return. And then like what happens in financial market and what happens in a mutual fund industry. So suppose understand it coming to the second point, regression to the mean is a fact of life. So what happened is, like suppose there's a mutual fund and that is performing really well. And then like everyone publishes their performance in the market. So what will happen is, like all the people will most many people will start putting their money into that mutual fund. So what will happen is that the fund manager might not have enough opportunities to cater to all those funds. And generally, we see the compensation structure in the industry is that a fund manager is generally compensated based on the like asset under management. So like it would be unwise for the fund manager to deny, saying that I do not have enough opportunities. Like most probably the fund houses will take that funds because they're in the business of earning money. So that's like regression to the mean is a very like this is a very standard term in the financial industry. So but say that when the fund manager will not have much good opportunity, so he'll invest into subpar opportunities, and the performance will not be sustained in the future. So today's winner might be like tomorrow's average performers or tomorrow losers, and then today's losers might be tomorrow's winner. What happen is like if a mutual fund is not performing well, and then so the people will pull out their monies, and then every fund manager have some good opportunities, so he'll invest in that good opportunities and then make good returns. So regression to the mean is a very this is a uh, all the all the successful investors take this into consideration, that regression to the mean is a very important fact. And then when you so just one call out here is most of this discussion is with respect to mutual funds only. When we and then another thing is when we are giving too much importance to the past performance, we have to consider this fact that how much performance we are attributing to managers' skills, and what sort of it is driven by market behavior. So like everyone is a genius in bull market if the market is high. For example, if we take the example during COVID time, the pharma companies were making a lot of opportunity, like lot of big profits. So if a fund manager, if a fund is concentrated into pharma stock, that will definitely make good returns. So this more of it has to do with the market behavior rather than the managerial skill. So it could have been the good company or bad company. If it has the pharma sector attached, it could have given the good return. This is also one consideration that we should think like what is the market behavior and uh, uh, what is the like skill involved in the game. And then the very first, this is the disclaimer that you'll find into every mutual fund prospectus is past performance may not be sustained in the future. This is true. Like we cannot make like true and false decision, good or bad decision. The decisions are a continuum here, so there's no right decision. So there's a lot of uncertainties and things involved. But since past performance cannot be sustained in future, so what will sustain? So, but if there is a right approach, prudence, and then a right investment philosophy, that should sustain in the long term. Because during a small period of time, uh, uh, during a small period of time, there may be some things that might have contributed to the return, but over the long run, the right approach should prevail. This is what we see in all the aspects of life. Now, before we go into anything regarding fund and anything, so very first decision. So if you go with any financial literature, you will understand that the very first decision a person has to make is about what should be his right asset allocation. So asset allocation means like how much of your investment should be in stocks versus bonds. The stock investments are more volatile. I'll not say it's risky, it is more volatile. They tend to fluctuate more in the short term, but in the long term, they tend to move upwards. And the bond investment, in bonds, there are a lot of options. For example, think of it like an FD or fixed return investment programs. So they are not volatile. The real risk lies in when you want to liquidate your investment, and like the market may be down, and then you may lose money at that point of time when you want to liquidate. So having set up this ratio is very important. And then there was a one study done by an investment institution in which they observed that asset allocation contributes to major differences in total returns. So what they did was they compared different funds, and then based on their asset allocation, they compared what is the difference in returns. So around 94% contribution of like 94% of the difference was explained by their asset allocation. So if they are more into stocks and more into bonds, then that contributed to the difference. Uh, Now, you might have this question like, what should be the right distribution for you? So there are a lot of options in this thing. Uh, So Benjamin Graham, so in his book, he has suggested the ratio of 50-50 should be there, because what happen is like we tend to make decisions based on a very short history, like what we have observed in past 2 years, 3 years. But then the markets are the long run, and then in long run, there are a lot of cyclicity and all those things. He suggests a ratio of 50-50. There's a lot of judgment involved here, but I'll not deep dive here. And then like there's one person, John Bogle. He's the most successful fund manager of USA, and then he suggests a ratio of 70% in equity, 30% in bonds. If you're in the early age, to 60-40 ratio, 50-50 ratio, as you like it depends on the age of your cycle as well. The very like why should you take this ratio, and then if this ratio will work for you or not? So there's a lot of involvement of your investment attitude. You might be a conservative person, you might have a lot of income streams, and then you might want to be more aggressive. So basically your attitude should define this. And then uh, uh, we like if you like if you reach out to us, we have compiled a good set of questionnaire from the internet, where you can analyze your investment attitude. So like you will understand how you behave, and then you'll understand your behavior, and how this how this is like impacting your financial decisions. So if there are few people I see who have joined late. So yeah, uh, like I'll quickly just recap it for 2 minutes, and then if you have any questions, like feel free to ask me anytime. Here what we are doing is uh, first of all, we are doing this series where we want to give like people a framework for doing the mutual fund investment. So we see like a lot of people make this mistake of focusing too much on past returns, and then not on on the right framework. So I will tend to create some framework for you, so that you can next time you do your some of your friend come to you and then brags about his fund. Maybe you can say to him like, let me think it from the perspective of this framework. So we'll cover the important aspects of what should be done. And then here we have discussed like past performance should not be given too much importance, rather right approach and then investment philosophy, they should be given much importance. And then the fund performance may not be solely due to manager's skill, but maybe due to market behavior as well. And then here I was discussing about asset allocation. So what should be your contribution in stock investments, and what should be your contribution in bonds investment. This is the very first this is a very important decision. So you cannot be you might be thinking like historically stocks have overperformed bonds over the long period of times. Given that you cannot put 100% of your investments in stock, because there are also times when the market is down 30%, 40%, the crash and recessions happens all the time. And then having this asset allocation is the very first decision that you should take. And then it will not help you it will help you prevent taking wrong decisions in such times. So now coming to like this series, like whether a mutual fund might be a good option for you or not. So the very first point is diversification. For example, if you're a person like who wants to invest, for example, 5,000, 10,000 rupees, so you will not be able to diversify properly. What happened is and then if you go by a mutual fund route, they have a lot of funds. So you get a very good diversification with a very little capital requirement. So this is one of the major advantage that is being offered by the mutual fund. But then there are a lot of critics of diversification as well. Many people say diversification is settling for mediocrity, like you will not make exceptional returns. The you and then you might know, like there are a lot of successful investors like Warren Buffett, Charlie Munger, Lee Lu. They have not made their money by diversifying. They have made their money by being concentrated on very few stocks, very few companies. But let us all agree we are not them, and then it will take us a lot of time to like reach the level of understanding and prudence. So like diversification should work for a normal person. Like if like a person is not in the exceptional category, he should settle with the average, like instead of losing money. And the second option is the liquidity. So you can buy anytime you want. You can sell anytime you want. So for example, if you are in a bond fund, so you cannot sell before the bond matures. But then via mutual fund route, it offers you liquidity. You can sell like whenever you want. And third thing is convenience. Like today, you can buy from your phone, and then they do all the compilation. If you receive the dividend, they'll automatically reinvest for you, and then they will calculate all the capital gains, and then like everything they facilitate the process so that you can just at the end of year you can download the tax statements for your convenience, and then all the record keeping and all everything becomes so easy. So yeah, like a mutual fund route might not be for everyone, but for most of the people, like it offers great advantage because like one thing is like money is managed by a professional fund manager. So and generally there are very reputed firms. For example, HDFC Asset Management, SBI Asset Management. A lot of big companies are there. So they have a certain framework of investment and everything. So it should work well for most of the people. Now coming to the main aspect of this session is like what should be the framework of evaluation. So here, like the last 3 points, cost, portfolio characteristics, and portfolio statistics are the major thing. So and then let me give you a like a brief description of the same, and then everything that I'm discussing, most of it is summarized in this blog, like analyzing a stock mutual fund. The very first point comes is the size of the fund. When we refer to size of the fund, is it is basically asset under management by the fund. Uh, so like why this point makes sense. This is important. So for example, you see like if a fund is new and then this is having a very small asset under management, for example, it's managing only 500 crores, and then not a big size. So it will impact the cost. For example, there are general costs. First of all, like the fund may not be sustained in the long term. Like they might close. It might close down. And second thing is that as the fund grow, there are a lot of expenses that are shared. For example, like the common expenses. For example, management, like the fund manager fees and the system cost and like lot of fixed. There are a lot of fixed costs. So if the fund is small, the cost will be distributed to a small section of people. But if the fund is large, for example, three times, four times, the cost that an individual person will born is like will get distributed in that proportion. So size of the fund is important parameter. So here, like I have mentioned, like you can exclude the bottom 10% of the fund. And then I was saying like in Indian context, what contributes to bottom 10%. So 100 like if a asset under management is 100 crore, then the fund like based on asset under management, it contributes to bottom 10%. And then there are two reasons. Like one is the like expense, and second thing is the fund may not survive. And then you might also think of excluding the top 5%. Uh, Top 5%. This is because of regression to the mean principle, as I mentioned. Like the when funds become very big, the opportunities might not be there. It's not like they will underperform or like they'll perform well or not. The second thing is the age of fund, like how long the fund has been in duration. So, for example, if the fund is like new, it has not been in the market for 2 years, 3 years, you may not want to consider like put your life savings there. Like you may want to like have a fund with at least 5 years in the market so that you're confident in this is working. And the tenure of portfolio manager is a very important thing. So every fund has a dedicated portfolio manager. So if a manager is having a particular investment and particular investment style or attitude, and then if manager changes, like then that thing might not be sustained. So so these are the small, like these are the common hygiene checks that and then this is not these points are not tough to find. You can directly find them like anywhere. The next thing that is very important is cost. So like what every fund does is like they compare their performance with other fund, like we are beating these funds, that fund. And then due to regulations, every fund has to compare this performance with the benchmark. So if the fund is here like the fund is charging more, and then if it is not able to beat benchmark, then there is no point in investing in that fund. And then if it is charging more, and then for example, if the fund is charging 2% and then it is beating benchmark by 1%, so like after cost, you're on a losing streak. So like the cost is a very important consideration. So in cost, there are two things that come. So I'll show you like how where you'll get all these information, and then how to make sense of it. Expense ratio is one thing, and second thing is turnover. Turnover is uh, like what is the frequency of buy and sell transaction that fund is doing. So if the portfolio turnover is very high, it means that portfolio manager is like rapidly buying and selling the securities. And this can create two three questions. One is like when a lot of buying and selling happens, there are a lot of transaction costs. For every transaction, there are a lot of transaction costs that are fixed. And then and then since these are mutual funds, they do not for example, they put money of like 100 crores, 200 crores. So in that way, like suppose they decide to put money in a one particular stock. So when like till the time they start buying and till the time they finish buying, because of their high buy volume, the price moves. So that is also like part of cost. And then there like the characteristics are portfolio concentration, and what is the market cap of the company that portfolio is investing in, what is the portfolio turnover, and the very important statistics on portfolio like R squared and beta. So I'll show you where you can get this. And so how where will I get this information? So for every information there's a prospectus. So for the demonstration purpose, I took So for the demonstration purpose only, I was seeing like Kotak Flexi Cap Fund, and then it was I saw like this fund has the highest asset under management. So I thought let's analyze this. When you want to analyze this, first of all, you can go to funds website. This is the Kotak Mutual Fund website, and this is the page. So here, in this page, you see a lot of information about the fund. So this is a Kotak FlexiCap fund, and then what is the fund objective? At any point of time, if you have any question or am I making sense, you can unmute and then ask it. So The thing of interest to us is this document section. So, like every fund will have this document section, and in the fund, there are two important documents. One is KIM, Key Information Memorandum, and second thing is SID, Scheme Information Document. So let's see, what is there? Let's download it. Just a minute. So let's see, let's go one by one and then see. These are size of the fund that you can get. Uh, let's see what this contains, and then you see you when you open this, you see this is a 17-page document, and then this is very compact. So just don't get overwhelmed. Will like the And then if you look into this document, this is a 119-page document. So when we go to this document, it should not take more than 30-40 minutes to figure out if to understand like what they are actually doing. And then we do not have to read all this document. We'll just seek answer to the question that we are having in the mind. Like if I go to this key information memorandum document, you see like what is the objective of this thing? Objective is long-term capital growth. Okay, and then here they have mentioned what they'll do is they'll invest in a portfolio of equity and equity related securities generally focused on few selected sectors across market capitalization. So here, this is important. You see, with this objective, you got to understand few things. Like one is this: they are doing this sector-based investment. So they are like sometime they may invest in pharma, sometime they may invest in IT. So they are doing they are focusing on specific sectors and across market capitalization. So they'll make investment across big cap, small cap, and all those. So they'll not exclusively focus on this large cap or a small cap. So if you find a fund that is specifically focused on a small cap, so like without so the very first thing when you compare the return is like you'll have to make like comparison. You cannot compare the large cap fund with a small cap fund. Like if a fund is a small cap, if it is giving higher return, so there's a more risk involved there. So everything is with respect to risk. Just understanding this one line gives you a perspective on what this fund is doing. So yeah, like this investment objective is the very important thing like generating long-term capital appreciation and then focusing on few selected sectors. And then this is asset allocation. Since this is a equity fund, so majority of their investments will be in equity. This is fine. And you see, like there are two options. Like one is the regular plan and direct plan. So like generally the expenses in the regular plan are higher, and in direct plan the expenses are lower. So every time you do, you should be in the direct plan, because what happens in regular plan is there are a lot of commission involved, like for the person who is selling you, and like marketing things are there. Yeah, and then this is an important thing. Like, what is the benchmark? So, like they're having this benchmark of Nifty 500 and Nifty 200. Yeah, this is the fund manager's name. So, like Harsha Upadhyay is managing this fund, and then he's managing this fund from 2012 onwards. So, yeah, this is this is an important thing, and like performance of the scheme. So you see how they're comparing with benchmark. So if we see like since inception, like from 2012 to till date, this is the uh, like when this when they might have published this report. Uh, so like this fund has given 13% annual return, whereas Nifty 500 has given 12% returns. And then if you compare their performance in like year wise, so last 1 year they have given minus 0.44, whereas benchmark has given minus 0.22. In 3 years they have given, whereas index has given approximately 18, and in last 5 years. So yeah, so generally in all the years, like if we compare up to 5 years, the index is performing better, whereas in long term, like this has given slightly more returns. Yeah, this is a good to know information. And then I earlier I mentioned you should invest in direct plan. You see, like the cost of investment in direct plan, you will be charged 0.66% per annum, and in direct plan, you will be charged 1.5%. So, for example, if you're in direct plan in this fund, if you see 12% in the benchmark, and then 1.5% you have given to the cost, so it like the post tax return from 13.4, 1.5% would have been the cost, so the total return that you would have got would be less than 12%. So that's why it's very important to consider the impact post cost. So there's like if a fund is if a fund is promising that it will give higher returns, and then it is charging like a higher cost, then like the performance is not like there's no guarantee whether the performance will sustain or not, but the costs are fixed, like, and like that will be charged to you. So there's no point in like giving higher cost if uh, higher cost. Okay, and then asset under management is like this is good. Like this fund is having 36,000 crore asset under management. So this is this is a very important line. This investment strategy. So equity and equity linked instrument, large cap, mid cap, small cap companies may it will invest. Here, this line, the fund manager will generally invest in a stock of few selected sectors, which in the opinion of fund manager has a potential to grow. So like the fund manager will make some sort of sectoral bets. So for example, during the time they might have focused more on this on more on this pharma stocks, and then during such time they like during different time they may have more concentration on FMCG or different things. So reading this is important. Like actually, it's giving us a perspective of what is actually happening, and then um, we are getting a sense like where we are getting into. Like just reading the name and just get like looking into the past return will not give us this perspective. Think what all the factors we have covered till now. Size of the fund, we say this is a big fund. The fund is in the market from a long duration. Like portfolio manager has been investing this, has been in this fund since 2012 onwards. So and like this factor is also fine. Expense ratio, like this fund, we cannot generally we will get a sense of expense ratio when we compare like multiple funds. So for the direct plan, the expense ratio is 0.66%. So if you it will make more sense like if you do comparison across multiple funds. So yeah, the expense ratio is fine here. Here this thing like will look into turnover, and then this portfolio characteristics and portfolio statistics. Now coming to this point, I will look into this turnover. So here one thing is portfolio characteristic, and then here we'll see the concentration. So like generally nowadays, this is lucky that we are getting all those information that is relevant in this key information memorandum document, and there are a lot of legal requirement for the funds to disclose this. Otherwise, we'll have to hunt, and then getting this information is not easy. And then this is a summarized version, so like most of the information you can get into this document. So Coming to the portfolio detail, so understanding portfolio top 10 holdings. So their approximately 10% of their investment is in ICICI. So if you see the list of companies here, it will give you a sense like whether these are large cap companies, small cap companies, and then majority of investment has been into which sector or which market cap companies. So for example, if I see like ICICI Bank, Reliance Industry, Infosys, SRF, so all these are very big names, and then all these are large cap companies, and then like there are three four companies here that comes from finance sector, and then so here we are getting a sense that, and then if we see this contributes to something around 40%, like this total, and then like around 40% of their investment is into their top 10 holdings, and then that basically comprise of this large cap, and then that is also like a bit more focused on this finance industry. So sector allocation is given here. So you see like at this point of time, like 30% of their allocation has been into this financial services, and then these are the like you might see like these are the sectors with like top like where they have investment more than 5%. So like financial goods, capital goods, IT, oils. So yeah, like this is giving us a sense like okay, and then uh, um, uh, here we can see for example like here it gives us a perspective on like earlier I was talking about how much of the performance of the fund is we can attribute to the market performance, and then how much of it can we can attribute to managers skill. So for example like if the financial services and banks if like the lending rate is good in the country and financial services are booming, so this fund will do good. And then this is the portfolio turnover. You see like in the last 1 year the port like 11% is the turnover. Let's discuss like what are the like how portfolio turnover negatively impacts this thing. Like how what impact it has on the cost. So there are two things. One is low turnover indicates that like the manager has taken its position based on long term like horizon, and then high turnover indicates the short term horizon. This is one thing. And then cost of managing the fund, like higher the turnover, higher the transaction cost, and then the turnover you see like 11%, and then this fund has around something around 36,000 crores. So if you see 36,000 crore into this 11%, that's a big figure. So this will have a lot of impact on the cost. So so here, when we discuss this portfolio characteristics, it helped us form a understanding on like where the fund is actually investing. So like this is like as I mentioned, this fund is like having highest asset under management. So this is a good fund, and this might be a good fund. And then here on the top they have mentioned they have mentioned like their investment philosophy. So in many of the fund the investment philosophy might not be very clear, so these things will help you understand actually what the fund is doing. So generally like you might find some fund that will have their investment objective like just and like not very detailed. So here we observe that it has been mentioned with great clarity, like it will focus on long term capital appreciation, they'll do sectoral investments, and then they will focus across market cap. And then we are getting this sense here. The so like there's another thing to check for is portfolio statistics and beta, and then let look into cost into more detail. You will find this. This is generally a scheme information document, and then it has this document like it here like if you go through the index, you will find like somewhere Uh, uh, Somewhere it is mentioned like fees and expenses of the fund, and then we are interested into this total expense ratio. So let's see what is the total expense ratio. So generally, there are some limits set up by SEBI on how much a fund can charge. So maximum a fund can charge like 2.25%. So these are the standard limits that has been set up. So this is the maximum expense ratio that you will see in any fund. So uh, subject to following limits. So these are the upper limits. So let's see like what is the actual they have. So here they have given the like how. So here we see like here they have mentioned like the fund will update current expense ratio on this website, uh, and then this is the link. So let's go and then see. Let's see like so see like here we get this total expense ratio sheet. Let's see what it consists of. Let's download for this period. If we see this expense ratio, so like what they have done is like so let's see like this flexi cap fund. So if we see this fund, so they have given like what are the expenses of a regular plan and what are the expenses of a direct plan. So we see like the expenses in this total expense ratio in the regular plan is 1.55, 1.59, 1.6. So generally these are, we can estimate it to be around 1.6, and in the direct plan we can see the expense ratio around 0.6. So there's generally a 1% difference in the regular plan and the direct plan for this fund. So see with this one, so so here like the expense ratio that you see on like here you can get a complete picture of the expense ratio. So like one more interesting thing we can observe from here. So let's see what is the total expense ratio for this regular plan, and then let's see like what is the like how much it is varying in different plan. So lowest plan has this expense ratio of 0.12%, and then it's going all the way up to 2.75% as well. So you see like the total expense ratio is so for example like the fund cannot like guarantee for the period of 10 years it can give like around 3% 3% more return than benchmark. But yeah, see, just based on the cost only, we can eliminate such plans like which is having higher cost. And then if we see like what is the range of in cost in the direct plan. So it starts from 0.07% and then goes all the way to 1.22%. So yeah, the point that I'm trying to make here is like there are comparing cost is a very important thing, and then it gives you a sense of comparing it. Actually it gives you a sense of what are the actual expenses, and then if the expenses are higher, so there has to be a difference, there has to be an alpha over benchmark to justify these costs. But yeah, like if a fund is so generally what will happen is like if a fund is uh, promising superior return, they will also charge higher costs. So that thing you have to take into judgment whether like these high costs make sense or not. So and then these are just the expense ratios, and then the impact of turnover is also there. So till now we have considered the size, age, cost. We have looked into cost. We have looked into portfolio characteristics, and then this particular piece of information give us more understanding on like what has been happening. Now, like looking into this very important thing of like R squared and beta. Beta just tell us beta is a beta tell like how this mutual fund and the benchmark are related. So if a fund is saying like the beta is 0.75, then what happens is like for example if there is a 10% market decline, so the fund will decline 10 into 0.75, like 0 is 7.5%. And if the index increases by 10%, so it's here basically we'll see what is the how much this is varying with respect to the benchmark. So uh, you'll get this information into this document, and then there is another document here, this one pager. So basically like uh, if you look out for these. So see here they have mentioned this thing. So here this is an interesting figure. You see they are saying like their beta is 0.94. So if the index is increasing 10%, like this mutual fund is increasing around 9.5%. So we see like there's a very high dependency on this. So like they might be more into like just replicating the benchmark. So and then here portfolio turnover is also mentioned. So it gives you a sense like what is the composition. So like how different they are from the benchmark. So because generally what happens is like if you invest in index funds and benchmark, so you'll not have to be a higher cost, and because the costs are not higher, so you can make more returns there. And then there's another statistics called R squared. So I like just in the interest of time, I'll quickly show it. So here, what I have done is that I have taken this last 1 year data, and then I have taken the closing prices of these fund. I have taken the so this data basically you can get from any of the from NSE website, and this data you can get from mutual fund website, or you can get from Yahoo Finance, Capital IQ, and then let's see like what is the correlation between this mutual fund and this Nifty 500, what they are claiming as the benchmark. There are some null values here. We'll have to exclude them. So you see, here, the correlation between this fund and this index is this 98%. So this gives us a sense that like much of it has been the much of the constituent has been the more of it. This is just replicating the benchmark more or less. So here we are more or less replicating the benchmark. So R squared give this sense. So you see like R square gives us an indication of what is the what is the like relative performance. R score of 95% or more, like this is like the fund is like more or less replicating index, but the in that like if you just have to like replicate index, you can better own an index fund, like it will save you cost, uh, you will get more returns after cost. So generally the point of like understanding all this is like you see at that point like what we have compared returns as well, but then beyond returns we have looked into like the more important things that are there, for example portfolio characteristics, portfolio statistics and costs, etc. So these things can be part of the framework that you can take into your own analysis while you're making this decision. So, like all of this analysis might like you might see this is a time consuming, and then I do not have time to do this. So, is there any easy option? And then, luckily, yes, there's an easy option. You can own the index fund. So, generally, like we are seeing the comparison with the benchmark, and then there are a lot of index funds, and then uh, we can explore, and then like the interesting point here is this: like generally, more than 80% actively managed funds underperform index over long duration, and then like this 80% is the figure that I have like reduced. Like the actual figure is more than this. So you see, like if majority of the actively managed funds are not able to underperform index over long duration, so maybe indexing can be a good thing that can help you grab your fair share. So since we are short on time, like I just want to give you a few takeaways that is the crisp of this whole discussion. One is do not chase the hot, don't chase the hot. So like a fund will be there that has given this you see there are fund that market they have given 35-36% return. This is just this performance is not sustainable. 35-36% CAGR, if someone is giving consistently, then like even the top investor like Warren Buffett and all, they do not have this ratio for themselves. Their CAGR does not stand at 35%. So there's no point in chasing like what is hot, what is being marketed, and create your investment objective based on your financial attitude. So understand your financial attitude, and then there are a lot of studies, lot of surveys you can give, and then like you fill the question and then you analyze it. So it will give you like your like what is your investment attitude. Based on that, you should have a personalized plan for you. And then a very important thing is the asset allocation, which I have been discussing from the start. And the last thing is indexing might help you like grab your fair share of return. So by indexing, you will not be an exceptional performer, but like you will not be onto that majority that loses money. So many people there was one post from from Jaruda's founder around I do not remember the exact statistics, around 60-70% people are not able to make more returns than like compared to FD in the trading. So this is the stats like he has posted some way back. So indexing will not give you an exceptional performance, but it will like you'll be better than 80% of the population without doing like much of the work. So yeah, like this is the conclusion. This is the takeaway, and then thank you for joining this. If you have any question, yeah, we can discuss those.